All right, everybody, welcome back to Matt Money. Apologies for my crazy hair, but it is what it is. We are just going to hop into it and talk specifically about real estate investment trusts and rental properties and what we think are better. So, I know this is going to ignite a lot of conversation. I'd encourage you guys to put that conversation in the comment section down below. And this could be something that we continue to discuss throughout the lifetime of the channel. It's something that I'm relatively familiar with, not necessarily on my own accord, but my family has a decent amount of rental properties. I own some REITs themselves, and I'm kind of stuck in between the two as well. This fits in well to discuss and bring into the channel because, as you guys know, my portfolio size is pretty good, and so I'm actually coincidentally down a house. So it is what it is. So I think this is just fitting. So if you guys are interested in learning a little bit more about Seeking Alpha and Seeking Alpha Premium, be sure to check out the link in the description. But I want to thank Jesse for creating this article. I read it this morning when I woke up, and I think it's really interesting to read through why this individual stopped buying rental properties and started buying real estate investment trusts instead. True for a lot of the summary pieces here, REITs are heavily discounted relative to rental properties. I do agree that housing prices have kind of just come back down to the normal, but they're not at a severe discount to what they should be. REITs may generate far higher returns in the future, but rental investors appear to disagree. And this article goes through extensively through several different lenses as to why REITs or rental properties themselves might be better. So Jesse released an article last week arguing that real estate investment trusts are expected to generate higher returns. And so he goes in a little bit about VNQ dropping about 33% and other REITs dropping closer to 40%. I'm personally in Realty Income. I'm also personally in STAG Industrial. And those have dropped rather significantly as well. And to the point where I'm looking at the price to funds from operations going forward, more so for STAG. I haven't really checked at the moment, but it's enticing. The fundamentals of the company still seem to be somewhat strong, but yet the price is discounted massively. So the value of the real estate that many own has not changed materially as a result. The price in steep discounts relative to the value of the real estate they own remains kind of unchanged. Real estate investment trusts have the opportunity to buy for things as low as 50 cents on the dollar, with the enjoyed benefits of diversification, management, limited liability, which is a huge piece, and liquidity for free. So this is basically looking at VNQ, the Vanguard Real Estate Investment Trust ETF, total return, over the course of, I guess, the not financial crisis, in course of the pandemic lows, up almost 120%. And of course, this was before the drop in 2022 began. But interesting enough to say, many rental investors refuse to accept that people who buy REITs are likely to earn higher returns than them, despite putting a lot less effort and taking less risk. The main pushback that many people get, receiving in the comment section, you can use leverage. You can buy rental properties with mortgages. Rental properties are more resilient to rising interest rates. You can enjoy significant tax advantages with rental properties. All very true. And so I decided to write this article to follow up and focus on those points specifically. Now, before I continue, one of the things that I notice a lot is people buying strictly rental properties for, let's just say, already renovated and ready to go, new construction, and then putting them on the market. Getting those 5 to 6 cap, if you're lucky, in the previous environment 6 months ago, you're not going to make so much money, right? You're going to get 5 to 6%. And over time, yes, rent will increase, your mortgage will stay the same. But over time, not going to be huge amount of benefits for that. where the huge value add, I think, for rental properties from my perspective is being able to put sweat equity in. And so if you're not able to put that sweat equity in, and buy a distressed more property and be able to renovate it and get it up to where you have equity in that home that you can then pull out and then purchase more properties, and then get that 5 to 6% return, right? Because not only are you getting that 5 to 6% return on, say, your total capital or everything like, and then you include leverage and stuff the like, but then now you actually have a free property that you were able to get by putting some money into the property, getting equity value out of that property, and then purchasing another property. And I think that that's the true advantage of buying rental properties. But in that respect, that's kind of what real estate investment trusts somewhat do. Well-run real estate investment trusts, I should add. But anyway, hopping back into this particular article, which I think was well done. You can buy rental properties with mortgages, talking about leverage. Rental property investors argue that REITs cannot compete with real estate properties because of investments that you can't buy with a mortgage. So naturally, if you're enjoying greater leverage, then you're also expecting higher returns, or in the case of the opposite, greater losses. Rental investors commonly buy properties with as much as 80% leverage, buying with 20% down mortgages, which materially increases their returns over time. But there's major misconceptions. What people ignore is that REIT investors, enjoy the exact same benefits of leverage without actually having to take on the mortgage in their name themselves. That's because you are buying a real estate investment trust. Investor is the equity, and it is the equity value that is traded on the market. Then that equity is then added debt on top of that to leverage your investments. They go to the market, they sell 100,000 shares to be able to get several $1 million to then be able to go out and buy more real estate. Therefore, a $100,000 investment in a REIT will commonly represent $200,000 or even $300,000 worth of assets. What you see is the equity value, but the vast majority of REITs also use leverage. I agree to this to an extent, but not 100%, right? I would say that with what you're buying with a REIT is not just the equity, but also a little bit of the equity and debt. But anyway, for the sake of just continuing through the article, let's just move on. So it's wrong to say that REITs don't enjoy the benefits of leverage. The difference is that REIT investors don't need to take on the mortgages themselves. The REIT does it for you already, which I agree with. It's preferably because REITs are often better terms than what you would expect to protect your personal liability, which I also agree with. Generally speaking, these REITs get really, really good loans. As a shareholder of the REIT, you are never personally liable for the debt, which is nice. And besides, if you think the leverage of a REIT is insufficient, you always take on more debt with a margin loan, which I don't necessarily agree with, or another source. This is not needed, but it is an option. Rental properties are more resilient to rising interest rates. The second point that I've seen some investors make is that REITs are more heavily exposed to the risk of rising interest rates. They appear to be justifying this point at the recent drop in REIT prices on the stock exchange, and comparing that to the greater resilience of their property values. The logic is flawed. Yes, REITs are significantly down in the course of STAG and which are ones that are on my portfolio, and WP Carey, which I think WP Carey has actually been holding up pretty well. Not the case, because interest rates are negatively impacting things, basically. REIT balance sheets today are the strongest they have been, with just 35% loan to values on average, mostly fixed rate and long maturities. Therefore, the impact of the fundamentals is not material. REITs have actually been growing their cash flow at a rapid pace, which I agree with. And the top 100 REITs have even hiked their dividend payments. Historically, REITs have actually generated higher total returns during times of rising interest rates. On average, generated 17% returns in 12 months following an interest rate hike, which is pretty interesting to kind of see. But generally speaking as well, stocks themselves in rising interest rate environments do well. It hurts when the interest rates are going up, but once interest rates kind of stop and flatten out, that's when stocks kind of return back to the mean. So simply looking at the recent stock market performance is quite misleading and tells you nothing about the future. The market is volatile and does funny things. He would argue that rental properties are actually far more exposed to the negative consequences of rising interest rates. Is because the most rental investors use far more leverage than REITs. So instead of 35% loan-to-value ratios, Rental investors use up to commonly 80% to finance their properties because the debt was so cheap in recent years. The home market was getting bubbly. Now rates are rising quickly, and as a result, home affordability has dropped to a multi-decade low. Looking at the monthly principal and insurance payments basically exploding about 100% over the past over the past couple of years. So it was hanging around about 800 to 1,000, and now it's over 2,100, rising very quickly. So this shows you that the home market was artificially propped up by ultra low rates, and you can see what happened in the last time that happened. Basically, in 2007 time frame, kind of came crashing down, and house prices dropped 20 to 25% pretty regularly. So there are REIT investors are much more protected because there are only two, American Homes for Rent and INVH, not sure what INVH is, out of 200 real estate investment trusts that invest in single-family homes. Commercial real estate is not as heavily exposed to rising interest rates. So REITs using a lot of leverage, a lot less leverage, than retail investors rental investors. Unlike home prices, REIT share prices have dropped heavily, which limits the further downside risk and provides a margin of safety. I would agree. You've seen a lot of that fluff kind of come out of the market at the moment, whereas I still think I'm seeing that come in to the rental market itself. And then the final argument is that rental investors simply enjoy the tax benefits that allow them to outperform. And so here again, Jussie is basically saying that there's a lot of misconceptions that rental investors get all these tax benefits while REIT investors do not. Yes, rental properties can be depreciated, which allows investors to defer the taxation of a portion of their cash flow, but depreciation is not a tax break. It's just a deferral tool. So it lowers the cost of your property, which means you get hit with an even larger tax bill in the future when you sell at a profit. You can defer the tax bill even further. You can defer the tax bill even further by doing a 1031 and redeploying the proceeds into another property. But again, you were just deferring the taxes, not eliminating them. And then this means you were stuck with a real estate for the rest of your life unless you accept to pay the tax bill. This could have significant indirect costs because you will lose flexibility. At times, real estate may become overpriced and unattractive as an investment. Even then, you won't be able to sell and reinvest anywhere. Also, the 1031 is ultimately rumored to be eliminated. This is a real possibility. REITs, on the other hand, also allow you to defer taxes by holding them in tax-deferred accounts, but you enjoy much greater flexibility over the investment. If and when REITs become unattractive, you can easily sell them and reinvest elsewhere. Besides, REITs are very tax efficient. Even when held in a taxable account, those tax benefits are extremely underestimated. REITs are fully exempt from corporate taxes, but still give you the limited liability benefits of a corporation. REITs typically only pay 50 to 70% of their funds from operations in the form of dividends. This means 30 to 50% of the cash flow is tax deferred, and since is retained and reinvested by the real estate investment trust. A portion of the cash flow that's paid in the form of dividends is technically classified as capital returns, and that is also tax deferred. A portion of the dividend that is taxed enjoys a 20% deduction. And finally, about 2/3 of the return actually come from appreciation, which is also tax deferred. Real estate investment trusts typically are faster growth, lower yield investments when compared to rental properties, which increases their tax efficiency. That goes out to many of you guys, which might be thinking that REITs are supposed to be high yield investments. I disagree. I think they should be in the 3 to 5% range. But you do see many people out there on the market looking for dividends, going for things that are 7, 8, 9, 10% yielding in the real estate investment trust market. I think those are dangerous. So no, rental properties do not enjoy material tax benefits that would warrant them being higher than real estate investment trusts. They actually pay fewer taxes investing in REITs than in rental properties. So then the bottom line is, the reason why they don't like the topic of REITs versus rental properties is that there are strong opinions on both sides and a lot of misconceptions. Jussie, in this case, has invested in both and analyzed this topic for years, and he has even written academic research papers about it. And the main conclusion is that REITs are rewarding in most cases, and that's particularly true when they are discounted relative to rental properties. Today, in this case, And this is why he is buying REITs instead of rental property. So he's not basically saying one is drastically better than the other, right? But it's all about when the opportunity arises, yeah? And I think what this article really shows really well is basically the opportunity to buy things at a good time and being able to pick them up when you see great opportunities, right? We're now seeing a drastic increase or decrease in the value of some of these things. I was looking at one of my favorite companies, which I'll probably do a separate video on, and it focuses on one very niche part of the real estate market that is doing extremely well, but that part where it's done extremely well has been influenced very distinctively by the pandemic, and had a huge 2021 because of the pandemic. And with that, we're now reverting to the mean a little bit. So with that, you are seeing a little bit of pullback in the price. One, because of the market that we're in. Two, because of the cooling off of the market that they are specifically focusing in. So that being said, great opportunity. If they're able to keep their price to funds from operations where they're at, it's way below historic norms. And if they're able to just continue to maintain this funds from operations and price to funds from operation for the next 2 quarters, which we'll be able to see, their idea is that they're going to be at $2.10, $2.20 for funds from operation for the year of 2022 annualized. So if they're able to maintain that and then be able to continue also grow that going into next year, the price that it's at today is at 11 to 12 times price to funds from operations, which is a great opportunity. And not only that, it's paying a 5% yield. And so I'm very intrigued at looking at this. It's one I actually have in my portfolio already. And if it continues to be as great as it is, I'll continue to potentially invest more and more money into it, and actually might reallocate capital within the portfolio into it, because I think it's a great investment opportunity if you're looking at where the price is today compared to where I think it should be in, say, 5 to 10 years, an easy 70 to 100% return, coupling that with a decent 5% yield on your money. So anyway, I just think it's a great opportunity to look at great companies. It's not to say that the high yielding companies are the best. I think it would be a good opportunity for people to look at the balance sheet of these companies, look at do they have secured loans, or are they battling variable rate mortgages? And there are some companies out there that actually do well and better when there is rising interest rates. I think that like Starwood Property Trust, STWD, actually does well because they're able to move up their loan costs, and since it's a mortgage REIT, but then you get coupled with less mortgages being issued and the like. So it's just an interesting time to do a little bit more research. And once and always, as I like to mention, if you don't want to do the research, that's fine. There's always something like the S&P 500 for you to just shovel your money into. But if you have the opportunity to do a little bit of research, a little bit of extra time to find something that you think is a great niche and has a great balance sheet, it could be a great opportunity, specifically now in these days when things have dropped 30 to 50% on the market. So really appreciate you guys stopping by for this one. Appreciate it as a longer video, but hopefully it was useful, and I'll see you guys on the next video. Cheers.